A very good day to all of you students. My instructor's name is Sayyid Zaki Ahmed. Today my lecture comprises of the valuation of bonds and preferred stocks valuation. Kindly see these lectures till the last to understand the intricacies of these topics. Please subscribe my channel for getting more advanced lectures. Now this lecture starts now, the financial management lecture number 8. This contains valuation of bonds in detail and the valuation of preferred stock in detail. This is in continuation with lecture number FM07. Let's get the laser out here. Now we discuss bonds. Bonds are debt securities issued by corporations, government or other organizations and sold to the investors. Backing the bond is typically payment ability of the issuer to generate revenue, although physical assets may also be used as collateral. Because corporate bonds are typically seen as riskier than government bonds, they usually have higher interest rates to attract the investors. Bonds have different features than stocks, and their prices tend to be less correlated, making bond a good diversifier for investment portfolio. Bonds also tend to pay regular stable interest, making them well suited for those on fixed income group. Now let's give you an example here, and we see the bond terms used to give you an understanding of the terms used here in the bonds. The face value is the value of the bond to be paid at maturity. In our example and coming one, we use $1,000 as the face value of the bond. The coupon rate is the amount of interest paid to the investor and is received annually or semi-annually or monthly, whatever is the term. Here it is received annually with a 10% rate. That means the interest the coupon pays is 10%. Now the discount rate is the required rate of return for the investor to attract to this bond. Required rate is the market rate available to the investor. Now here in this example it is 12%. Maturity date is the date at which the bond will be paid back to the investor. Here we have 5-year period from the date of the purchase. Now let's review the example given in the previous slide. Now in the example you can see we have a face value of $1,000 and the bond pays a 10% face value. That means annual interest payments. When the discount rate is 12%, ordinarily the investor will not be attracted to this kind of bond. But there are certain ways the investor will buy this, purchase this, but at a lesser face value. So here we know one thing, the bond is issued at a premium when the coupon rate is greater than the discount rate. The bond's purchase price greater than the face value. An investor is willing to pay more than the face value because the expected cash flow from the bond will be greater than the required rate of return. Similarly, conversely, the bond is discounted when the coupon rate is less than the discount rate. The bond purchase price is less than the face value because the expected cash flows from the bond is below the required rate of return. So the investor will only be attracted if the face value of the bond is reduced. So here we have an example now. How much would an investor pay to purchase bond today which is redeemable in 4 years for its nominal value or face value or $100 and pay an annual coupon of 5% on the nominal value? The required rate of return or yield to maturity for the bond is, in this risk class, is 4%. Let me bring my laser out. Now here we solve this question. This is year 1, 2, 3 and 4. The cash flow is $5, $5, $5 as a coupon, and at the end of the year 4 we have $100 face value returning back to the investor and a $5 coupon value. Now we see the present value here, which is at year 1, rather year 0. So we have a 5% of 1.04 present value here, 4.81. Present value at the second year is 4.62. Present value at the third year is 4.44. Similarly, present value of at the face value is 89.75 on the return of $100 and $5. So these present values are calculated here at year 0. So the present values of the cash flow become 103.62, right? Let's take the laser out. Now how do we price the bonds and the yield to maturity? Now the bonds price is equal to, at any time, the present value of the expected future cash flows, which include the coupon rate and the face value of the bond. The yield to maturity is the word used for discounting bonds. Normally it is the required rate of return by the investors in the market. So we value bond by the required rate of return, or that is called yield to maturity. Now how do we price these bonds? We have this formula. Present value is equal to summation of cash flows divided by 1 plus y, where z is the period. Similarly, face value divided by 1 plus y raised to the power n number of periods. Now here you can see the value of the periodic payment, that is C, that means coupon rate. Y is the yield to maturity. The bond's par value or face value is F. T is time with the smaller t. Similarly, the bigger T means the number of period until the bond is matured. Now let's do another example. Suppose that the bond has a face value of $1,000, a coupon rate of 4%, that means the coupon will be 4%, let's say annual, and the maturity of 4 years. The bond makes annual coupon payments. If the yield to maturity is 4%, the bond price is determined as follows. The solution is on the next slide. Let's see that. Now let's see, our laser pointer is out now. Now we are going to compare different bond prices at different YTM. That means if the YTM is the value of interest, that is required rate of return required by the investor in the market. Now at the 4% interest rate, that is the required rate of return also, that means YTM is 4% also, and the coupon rate is also 4%. Let's see these present values. Here the present value is equal to 1000, that is the face value of the bond. Let's increase the yield to maturity to 5%. That means the bond yield to maturity or required rate of return now becomes 5%. It is higher than the coupon rate. Now similarly, now we value this present value of the bond. Same face value, 40, 40, 40 and 1040, that is the 1000 plus your 40 coupon rate. Let's see the present value now. Now it becomes 964.54. That means the bond maturity value will be 964 value, so it will be sold at a lesser price than the face value. Now the yield to maturity is 3%. The price is, now we calculate the same value under 3% yield to maturity. Now the value becomes 1037. You see the coupon rate is higher, that means the present values of the cash flows will be higher, and so the value becomes 1037 at year 0. So this is the difference of yield to maturity when we use these values in bonds. So this is the way we value bonds. Let's discuss now the stocks also, the preferred stocks. The common stock we have discussed already in the previous slide, in the previous lectures. So kindly refer to my lecture 7 for the stock valuation. Now this is the preferred stock we are going to discuss now. The stock refers to the ownership or equity of the company. There are two types of equity or common stock and preferred stock. Preferred stockholders have a higher claim to the dividend or asset distribution than common stockholders. The detail of each preferred stock depends on the issue. Now students, let's discuss the preferred stockholders. They have higher claim on distributions, on dividends and common stockholders. That means they are after bond, they are given first priority before common stock in paying them. Preferred stockholders usually have no or limited voting rights in corporate governance. That means they don't have or limited rights in voting the company's management. In the event of liquidation, preferred stockholders' claim on asset is greater than the common stockholders but less than the bondholders. The preferred stock has characteristics of both bonds and common stock, which enhances its appeal to certain investors. Now, how do we value the preferred stocks? Now, if the preferred stocks have a fixed dividend, then we can calculate the value by discounting each of these payments to the present day. The fixed dividend is not guaranteed in common stocks or shares. So if we take these payments and calculate the sum of the present values into perpetuity, you will find the value of the stock. It's not very difficult. Now let's do another example. The ABC company pays a 25-cent dividend every month, and the required rate of return is 6% per year. Then the expected value of the stock using the dividend discount approach would be $50. The discount rate was divided by 12 to get 0.005. but you could also use the yearly dividend rate of $3. That means 0.25 multiplied by 12 and divide it by the year discount rate of 0.06% to get $50. In other words, you need to discount each dividend payment that issued in the future back to the present when they then add each value together. Now the formula stands here: D1 divided by 1 plus R for the first year, D2 divided by 1 plus R raised to the power 2, similarly D3 divided by 1 plus R raised to the power 3, plus dividend DNL final one divided by 1 plus R raised to the power n. So we solve this problem in the next slide. Now students, let's compare the stock characteristics of each of these units: bonds, preferred stock and common stock. Let me get my laser out here to point you out. Now I give you characteristics of each of these stocks. The ownership stake in the company is: bonds are debt holders, equity ownership for the characteristic is there for preferred stock, common stock equity owners basically. The upside growth, if we compare all these three units, bonds growth is unlimited, preferred stock is limited till it is convertible to the common stock. For common stock it is unlimited. Risk: with bonds least risk and price volatility. Medium risk with preferred stock and price volatility. Most risk and price volatility in case of common stock. How about the voting rights now? Bonds have none, preferred stock in their present condition none, common stock proportionate to the ownership level, that means the value of the stock. Now the distribution of assets in case of bankruptcy. Now in case of bonds, interest must be paid before dividends. In case of preferred stock, paid after bondholders but before common stockholders. In case of common stock, the funds remaining are paid to the after clearing the bondholders and the preferred holders, stockholders. Payout: in case of the bonds, guaranteed interest at lower yield than preferred. Preferred stocks, fixed dividends with higher yield than bonds or common stock dividends. With common stock, dividends are not guaranteed. So these are the characteristics of all these three stocks. Continuing with our characteristics now, again the preferred stocks are traded on the stock exchanges similar to common stocks, which provide pricing transparencies. However, most companies do not issue preferred stock because they are expensive and risky also. Total market for them is small and liquidity can be limited. The most common issuers of preferred stocks are banks, insurance companies, utility companies, and real estate investment people who have money or liquidity. Companies issuing preferred may have more than one offering for you to vet. You see, the preferred stocks can be of different uh, how I cannot call characteristic, can be of different options. Often you may find several different offerings or preferred from the same issuer but with different yields. Before purchasing preferred, an investor can review the credit rating from Moody's or S&P for each particular offerings and take ratings into consideration before the other features such as yield, reliability, callability, and convertibility. Continuing with the characteristics again now, in this slide, the preferred stocks can be convertible. That means that they can be converted to common stock if opportunity given and by the company. They can be converted into common stock, taking the ownership also according to the common stock. Preferred stocks normally are perpetual. Now bonds, we know that we have a particular period and the company returns that money back to the investors after that period when it matures. Preferred stocks does not have this quality, but they can continue till the company calls. That means it repurchases the preferred shares. Otherwise they can remain outstanding indefinitely. Now the preferred dividend can be postponed. That means skipped entirely also at some time if the company needs money for dividends for the common stock and preferred stock. But they have to, that cumulative dividend of the past and the present has to be paid later on. This postponement quality gives preferred stock a little bit of advantage as compared to other stocks. Now that ends our lecture 9 of financial management. Now our next tentative lecture will be on leverage analysis. Keep in touch with my channel Mindbenders and you will receive the next lecture also. I end my lecture with this bond voyage. So kindly refer